The NASDAQ, it's about even with the broader market here in 2021, and we're seeing some evidence that when investors said they were going to rotate into materials and industrials, that they're actually doing it. Both of those sectors up 4% this year. Tech only up about 1.5%. Do you see this trend continuing?
Well, it really depends where you go. In terms of the indices, could very well be the case. Rising rates certainly are a headwind for high multiple stocks, and that's really where investors have to take care. But it's not just those sectors you mentioned, Frank, right? It's also energy and financials, and that makes a great deal of sense, right? We're at the beginning of an economic recovery. And so when we look for selecting individual stocks, which we hold for our clients, what we want to do is still stay exposed to tech, but we want to be a lot more careful about it. We want to avoid those high multiple stocks, which can tend to pull back, as we saw, pretty sharply when rates rise, and rightly so. Those higher rates are higher discount on future earnings. And so therefore, those multiples are likely to contract. That's going to be a headwind for some companies. But we still find an awful lot of places we can go in tech to make sure we give exposure to growth for our clients, as well as the broader economic reopening play that we are really enthusiastic about this year.
Well, Joanne, we're going to get to some of your picks in tech in a minute. But first, I have to ask you a question I think a lot of people on Wall Street are asking. Why don't earnings and guidance matter anymore? We saw Zoom. They had a great quarter, and then the stock dipped. It's up today on the pre-market, important to note. And then we saw other companies like Logitech, really good earnings, really good guidance, and the stock's been down ever since.
Well, there's a lot of the growth that's been built into these stocks already. I mean, look at what happened last year. And particularly these companies that were really exposed to the move to stay-at-home trends. People have been saying it's like 5 years worth of growth were pulled into, the 10 months since COVID started. And so I think investors are looking for a bit more. And when we compare the actual earnings to expectations, one has to also adjust for what the investor expectations are, the professional investors, as opposed to what the sell-side analysts on Wall Street are saying. And obviously it's the case now, right, that the institutional investors are putting much higher numbers on those earnings expectations than the sell side is doing. And that's actually not uncommon if you look at the data. Typically, sell side analysts are a little bit behind earnings, and they like to see them beat by the companies when they report. And so it doesn't surprise us that those so-called whisper numbers of the institutional buy side are running above the expectations that are printed in the consensus figures that most people cite when they compare earnings to the expectations.
So let's get to some of your favorite places to invest. You're actually a big fan of fintech. You gave us a couple names, Stone, Encino, and PayPal. But it's important to note that financials this year, they're up big as these interest rates have risen. How does this interest rate story play out with these fintech companies?
Yeah, there's less of a connection there. One does have to be careful, pick and choose, but these are companies that do have higher multiples. Why do we still like them even though rates are rising? Because we think that their growth potential is actually well ahead of where expectations currently sit. If you look at fintech, you're asking the question, how important is the move to digital currencies? And I don't mean Bitcoin, I mean the digital transactions that are really taking over, particularly since COVID started. Stone Company, for example, is Brazil's version sort of PayPal. And in Brazil, it's just beginning to see the transition from cash payments, in-person payments, to online ordering, and to these digital payments. And so we think there's actually a lot of growth ahead, and these companies typically have a lot of leverage. So as revenue goes up, earnings go up even more. So we think these companies, Stone, Encino, PayPal, can actually stay ahead of the headwind coming from rising rates.
Shepard Smith here. Thanks for watching CNBC on YouTube.